Hello students, in present video I am going to explain about accounting equation. So this is a primary accounting principle. Accounting equation is given by American accountants. Accounting equation is also known as basic accounting equation or balance sheet equation. This is the meaning of accounting equation. Accounting equation is a mathematical expression which shows that the assets and the equity of a firm are equal. So this definition, if you show in equation form, assets is equal equity. Here assets are also known as economic resources. Equity is also known as claim. So, and the equity is divided into two types: owner's equity, creditor's equity. Owner's equity is also known as capital. Creditor's equity is also known as liability. Therefore, equity we can write as capital plus liability. So, capital plus liability is equal equity. In other words, owner's equity plus creditor's equity is equal to equity. So this equation, assets is equal to equity, we can mention in this manner also. Assets is equal, equity means capital plus liability, no? So instead of writing this equity, here we can write capital plus liability. So generally as accounting equation, this equation is used. Assets is equal capital plus liability. Suppose in question, capital is missing, then how to calculate that? Assets minus liability is equal capital. Suppose in this equation liability is missing, then how to calculate that? Liability is equal assets minus capital. So here in accounting equation there are three elements now: assets, capital, liability. In present video only I am going to explain about these three elements in detail. So before to that, let us see one problem regarding this equation. This problem I am taking from Kalyani publications. Question is, you are required to complete the gaps in the following table. This is the question. Assets are given, liabilities and capital. In A bit, assets and liabilities are given, capital is missing. We have to calculate this. In B bit, liabilities and the capitals are given but assets are missing, and so on. So let us see the solution for this. A bit, what is missing? Capital is missing. This formula we should use now. Capital is equal to assets minus liabilities. Capital is equal to assets minus liabilities. In A bit, asset is equal to 1,10,000 minus liability is equal to 33,800. So answer is 76,200. Next, B bit, asset is missing. This formula we should use. Asset is equal capital plus liability. Asset is equal capital plus liability. Capital in B bit 68,800 plus liability 34,400. So total is 1,03,200. Then C bit, liability is missing. So this equation we should use. Liability is equal assets minus capital. Asset 72,200 minus capital 57,000. In C bit, liability is equal asset minus capital. Answer 15,200. D bit, capital is missing. So this equation we should use. Capital is equal to asset minus liabilities. Capital is equal to asset minus liability. Amounts when you write, answer is 2,08,200 rupees. E bit, liability is missing. This equation, liability is equal to asset minus capital. Asset minus capital is equal to 52,000. Last one, asset is missing. So this equation, asset is equal capital plus liability. Capital 2,20,000 plus liability 98,000 is equal to 3,18,000. Thus, by using this accounting equation, missing figure we can find. Now, let us know in detail about these three elements: assets, capital, and liability. Before knowing the meaning of this accounting equation, let us see about each element. First one is asset. Asset means the property or a thing which is owned by the firm, which is owned by the business organization. Suppose there is one company. So company purchased one factory building, office building, godown, showroom. So all these buildings are owned by the company, no? So to the company, all these buildings are known as assets. To manufacture goods, company purchased one machinery. So machinery comes under an asset. Then these assets have some economic value. So this machinery, if you sell on second hand, then some cash comes. No? Suppose company has one land asset. If we sell this land, then company can get some cash. No? So these assets have some value. If we sell them, we can earn some money. Then assets are useful to run the business. So without these assets, without land, building, machinery, furniture, cash balance, bank balance, company cannot run its business. So these are useful to run the business. For example, machinery is useful to manufacture the goods. Bank balance is useful to meet day-to-day expenses, to pay salary, to pay building rent, to pay electricity bill. We use either cash balance in the firm, otherwise bank balance. So we use goods for sales purpose. Thus, assets are useful to run the business. In business, we have to execute so many functions now. So buying raw material, manufacturing of goods, so recruiting the employees, labor, so providing training to them, meeting day-to-day expenses, advertisement, selling the products to consumers, delivering the goods to their houses. So all these are business activities. So to execute them, we use all these assets. So assets are useful to run the business. Then these assets are divided into two types: current assets and fixed assets. Current assets means what? If any asset is useful for a short period, that asset is known as current asset. Here short period means less than 1 year. For example, with us cash in hand is there. So in our firm, in cash box, we have some money to meet day-to-day expenses. Say 50,000. Do we keep this money as it is for 20 years? No. Within a short period, within 1 year, we are going to spend this money. Suppose in our bank account, we have some balance. So bank balance also we use to meet business expenses. Suppose in our bank account, we have some money. So we are going to use that amount within 1 year to meet day-to-day expenses, to pay salary, to pay electricity bill, etc. Suppose we have some goods with us. Goods means selling item. Suppose stationery shop. They sell stationery items now. So for a stationery shop, stationery items are goods, also known as inventory or stock. So if we have stationery items in his shop, within 1 year, he is going to sell them to customers now. He is not going to keep them for a long period. So remember, all current assets are useful for a short period. Firm uses them for less than 1 year. Next, these current assets are liquid assets. Means what? Within a short period, we can convert this current asset into cash. Suppose debtors. Debtors means firm sold goods to customers on credit. So customers have taken goods from us, but they have not yet paid for that. Now they are liable to the firm. So they are known as debtors. So debtors means a person who is owing money to the firm, asset to us, and while selling goods on credit to them, maximum credit period allowed is 3 months, not more than that. So within 3 months, this debtor asset is going to convert into cash form, because within 3 months from them we are going to receive money. Similarly, investments. Suppose we purchase short-term investments, treasury bills we purchased. certificate of deposits we purchased. So all these investments are meant for short period. So within 1 year, we are going to get back our money. Within 1 year, these investments will get matured. Thus, all these assets can be converted into cash within a short period. So these assets possess liquidity quality. And examples for current assets: cash in hand means cash balance in our firm. Cash at bank. Stock, also known as inventory or goods. Bills receivable. Prepaid expenses. For example, prepaid salary, prepaid rent, etc. Income to be received. For example, interest to be received, commission to be received, etc. Investments and debtors. So current assets completed. Next, fixed assets means what? If any asset is used by the firm for a long period, that asset is known as fixed asset. Here long period means more than 1 year period. For example, a company purchased a machine to manufacture goods. Only for 1 year they use this? No. So they are going to use this machine for a long period. Say machinery life is 10 years. So company uses this machine for 10 years. 10 years means above 1 year, long period. Similarly, company has one building, own building. So this building company uses at least for 20 years, 25 years for long period. So furniture, building, land, machinery, vehicles, all these assets are useful for a long period. So they come under fixed assets. And fixed assets have poor liquidity quality. Suppose company has one building. So today morning they have decided to sell this building. They want to convert that building asset into cash form. So within 1 day, within 2 months, can they convert into cash? No. So it takes a lot of time. If you want to sell at expected sale price, then you have to wait for a long period. So fixed assets have poor liquidity quality. And fixed assets are divided into two types: tangible fixed assets, intangible fixed assets. Tangible fixed assets means they have physical existence. We can see them, we can touch them. For example, machinery, you can see it, you can touch it. Other examples are building, furniture, fixtures and fittings, loose tools, plant, land, vehicle. All these are tangible fixed assets. Next one, intangible fixed assets. So they do not have any physical existence. You cannot see them, you cannot touch them. But we can feel the existence of these assets. So these assets are also useful to run our business. Example, patents, trademarks, copyrights, goodwill. So this is all about first element, asset. Second element in accounting equation is capital. Capital is also known as owner's equity. Suppose Ravi wants to start a business. To start a business, Ravi invested some money. So that amount is known as capital. So to start a business, the amount which is invested by the owner is known as capital. Suppose Ravi wants to start a stationery shop. Generally, he brings money to start the business now. Don't think that always capital will be in the form of cash. Sometimes capital may be in the form of goods or other assets. For example, this is stationery shop now. So Ravi has some goods at home. Ravi has 10 notebooks at home, unused notebooks. Instead of keeping them at home, he can bring these goods into the shop now. Books he can sell in the stationery shop. So here capital is coming in the form of books. Similarly, capital may be in other asset form also. Suppose for this shop, Ravi needs one fan. Fan he is not going to sell in stationery shop now. So fan doesn't come under good. It comes under fixed asset. At home, Ravi has a new fan. So why to buy the fan from outside for business? This new fan from home, Ravi brought into the shop. Here, capital is coming in the form of fan. So in case of sole proprietorship, single ownership, who is bringing this capital? Ravi. So Ravi is the owner of this business. That is why this capital is also known as owner's equity. Suppose you take joint Hindu family business. Who brings capital here? So that family members from joint property, they invest money. So these family members are owners there. Otherwise, partnership. So here capital is brought by the partners. If A, B, C, three partners are running a business, then these three members bring capital, no? And A, B, C, three members are owners. So as owners are bringing this capital, capital is also known as owner's equity. And while learning about this capital concept, you should know about one word, shareholders equity or stockholders equity. In case of sole proprietorship, JHF, partnership business, for capital we can use owner's equity word. But in case of companies, public limited companies, instead of using owner's equity word, we can use shareholders equity or stockholders equity. Suppose take one limited company, ABC Limited. So they want capital 100 crores. Joint stock company, no? So they need huge amount. So 100 crore, one member, two members cannot invest. So what they do? That required capital, they divide with one number. Say with 10 rupees, they are dividing this required capital. 0, 0. 10 crore part scheme. So the total required capital is divided into 10 crore parts. Each part is known as one share. One share price is how much? As we are dividing with 10, one share price is 10 rupees. And company sells these 10 crore shares to shareholders, to public, to investors. Assume 1000 investors purchase these 10 crore shares by paying some amounts. Here, capital is brought into the company by the shareholders. Therefore, this capital is known as shareholders equity or stockholders equity. So this is all about second element, capital. Then third element is liability. Liability means what? When firm takes loan from outsider, that is known as liability. So from insiders, when firm is taking loan, that is known as capital. No? Insiders means firm owners. From outsiders, when we take loan, it comes under a liability. Suppose firm is taking loan from a bank. So here bank is outsider. Therefore, that bank loan comes under a liability. Otherwise, firm is buying raw material from supplier on credit. So here firm is taking loan in the form of raw material and supplier is outsider of our firm. So from outsider we are buying goods now. Then that supplier comes under creditor. So because we are due to him, so creditor is one outsider. From creditors, when we take loan, that also comes under liability. Then liability is divided into two types, short-term liability, long-term liability. If loan is taken for a short period, it comes under short-term liability. Here short period means less than 1 year. If loan is taken for a long period, for above 1 year period, that loan comes under long-term liability. Examples, bank overdraft, creditors, bills payable, outstanding expenditure. For example, outstanding salary, outstanding rent, income received in advance. For example, interest received in advance, commission received in advance. All these are known as short-term liabilities. For long-term liabilities, examples are mortgage loans, bonds, means loans taken in the form of issuing bonds or loan taken by issuing debentures. With this, you got some idea about these three elements of accounting equation. Now let us see some more points about this accounting equation. Accounting equation tells the relationship between asset, capital and liability. It tells that firm purchases assets with the owner's capital and loans from outsiders. With one example, we'll see this. Ravi wants to start a business. For that, he needs 20 lakh rupees. So, his savings amount, 15 lakh rupees, he brought into the business. For remaining 5 lakh rupees, he took loan from bank. So, here, bank is outsider. So, from outsider, he is taking loan. Therefore, this 5 lakh is known as liability. And his own money he is investing now. So this 15 lakh rupees is known as capital, owner's equity. So capital plus liability, total 20 lakh rupees is known as claim. So claim means what? Obligation, responsibility. So firm has to pay 20 lakh rupees to creditors. Here you may get one doubt. Bank is a creditor, no doubt in that, because outsider. Why firm should pay 50 lakh rupees to Ravi? So Ravi, firm, both are same only. In accounts, we follow accounting concepts and conventions. So in accounting concepts, there is one concept known as business entity concept. What that concept says? While maintaining accounts, accountant should assume that firm is separate, owner is separate. So owner is bringing capital now. We should assume that we are taking loan from one outsider. So capital is also a liability for us. So that is why capital is also a claim. With this 20 lakh rupees, Ravi acquires property. Assume with the 8 lakh rupees he purchased machinery. With 5 lakh furniture. With the 3 lakh rupees goods. So in 20 lakh rupees, total 60 lakh rupees he spent to acquire assets. Remaining amount is 20 lakh minus 16 lakh, 4 lakh rupees. In this 4 lakh rupees, he deposited 3 lakh 50,000 rupees in bank and he kept 50,000 with him in the firm to meet day-to-day expenses. So here, total 20 lakh rupee is known as resources. So resources means what? Properties, assets. That is why in starting of this video, what I said, asset is equal to equity. In other words, resources is equal to claim, because assets means resources and equity, nothing but capital plus liability is claim. So resources, assets, and to acquire these assets, the claims which we created. So the responsibilities which we have, the amounts which we have to pay to creditors. So the assets and the claims both will be the same. So this is accounting equation concept. And one more important point regarding accounting equation is applicable in double entry system. So what do you mean by double entry system? Let us see. Suppose you are working as an accountant in one organization. In your organization, daily so many activities take place. No? All these activities are known as transactions. These transactions are divided into two types. Business transactions, non-business transactions. Some transactions are related to your business and some are not related with the business. For example, businessman paid salaries to employees. So salaries paid, this transaction comes under business transaction because this transaction financially affects the business. One day, employees celebrated owner's birthday. So this is also an activity, but this activity is not related with our business now. Therefore, it comes under non-business transactions. So accountant has to concentrate on business transactions. He need not to record non-business transactions. And the business transactions are again divided into two types. Monetary business transactions, non-monetary business transactions. Means some business transactions value we can express in terms of money. Some business transactions value we cannot express in terms of rupees. For example, salaries paid to employees. How much? 5 lakh rupees. So salary paid, this transaction is expressible in terms of rupees, no? It comes under monetary business transactions. Workers went in strike. So this is also business related transaction. It affects business. But strike, so its value we cannot tell in terms of rupees, no? Therefore, even though it affects our business, we need not to record this. So in business, accountant has to record monetary business transactions. Why? Because businessman wants to know two important informations. 1 year he did business. In that business, whether he got profit or loss, he wants to know. Second, what is his financial position? Financial position means how many assets are there, what are their values, how many liabilities are there, and their values. So to know these two informations, accountant has to record all monetary business transactions in the books. So to record monetary business transactions in books, there are two systems, single entry system and double entry system. So we will concentrate on double entry system because accounting equation is created based on double entry system. So under double entry system, monetary business transactions are recorded in terms of debits and credits. So to record debits and credits under double entry system, two methods are there. First one, conventional method. Second one, American accounting method. So this accounting equation is related with American accounting method. That is why before knowing about this, you should know about these two. So first one, conventional method means what? Under this conventional method, debits and credits are recorded by following golden accounting rules. What are golden accounting rules? Accounts are divided into three types: personal accounts, real accounts, and nominal accounts. If any account is opened with a person name or firm name, it is called personal account. For example, Kiran account, State Bank of India account. If any account is opened with asset name, it is known as real account. For example, cash account, missionary account. If any account is opened with the expenditure name, loss name, income name, or gain name, that account is known as nominal account. For example, salary account, commission received account. What are the golden rules? For personal account, golden rule is debit the receiver, credit the giver. For real account, debit what comes in, credit what goes out. For nominal account, debit all expenses and losses, credit all incomes and gains. So by following these accounting rules, how debits and credits are recorded under conventional method, let us see with one example. Example is, one firm has taken loan from State Bank of India, 10,000 rupees. So what happened here? We are an accountant of firm now. Think from firm's point of view. From State Bank of India, cash is coming to us. This is one transaction. And this transaction value is 10,000 rupees. Means this is monetary business transaction. So we have to record this in the books. How to record? Here, cash is coming to us. Cash is an asset now. So assets come under real account. As per real account, debit what comes in. So here cash is coming into the firm. Therefore, we have to debit cash account. So cash account is a real account because cash is an asset, and as cash is coming into the firm, we have to debit cash account. Next, another account is from SBI, we are taking loan. So because of this transaction, one liability is increasing. One liability is newly created. That liability name is loan from State Bank of India. So second account is loan from SBI account. So if you take or if you give loans, they come under, these loan accounts come under personal accounts. So loan from State Bank of India is a personal account. Personal account rule, debit the receiver, credit the giver. Here bank is giving loan to us, bank is a giver. Therefore, this account we have to credit. So what is the final entry for this? Cash account we should debit, loan from State Bank of India account we should credit. Therefore, journal entry is cash account debtor to loan from State Bank of India account 10,000, 10,000. So in journal we write a journal entry like this. Then in ledger we prepare cash account and loan from State Bank of India account separately. In these two accounts, this entry we have to record. So that recording is known as posting. How to record? In cash account. So this is called cash account. Account is divided into two sides. Left side is known as debit side to indicate that DR symbol. Right side is known as credit side to indicate that CR symbol. So debit side columns are date, particulars, journal folio number, amount. Credit side also same. And in this journal entry, cash account is debited now. Therefore, in cash account, this entry on debit side we should post. And what to write in particulars column? Other side account name. So credit account is loan from State Bank of India now. Write on that. To loan from State Bank of India account 10,000 rupees. Now same journal entry we are to post in loan from State Bank of India account also. In ledger, second account name is that. Here we said we should post. In entry, loan from State Bank of India account is credited. Therefore, this entry in that account, credit side we should post. Now in particulars column, what to write? Other side, debit side account name, cash account. So by cash account 10,000 rupees. So observe here, under this conventional method, what we are doing? There is one transaction, loan taken from State Bank of India. This transaction is containing two accounts, cash account, loan from State Bank of India account. So one account we are debiting, other account we are crediting. So in double entry system, every transaction is recorded in the form of debit and credit. So in one account we debit the transaction, in another account we credit the transaction. And observe the amounts. We debited 10,000, we credited 10,000. Means debit and credit amounts are same. So every transaction is recorded in this manner only. So in one account debit side we record, in another account credit side we record. Same amounts. When you record debit and credit same amounts for every transaction, at the end, if you do the totals of these two sides, total should be same now. So debits and credits should be same under double entry system. So this is all about conventional accounting method. Next one, American accounting method. Second method is American accounting method. So Americans have created a separate method to write the journal entries. So accounting equation is based on this American accounting method only. And according to them, monetary business transactions are divided into 7 types of accounts. In conventional methods, accounts are divided into 3 types now. Personal accounts, real accounts, nominal accounts. Under American accounting method, accounts are divided into 7 types. Assets, liabilities, capital, incomes, expenses, profits and losses. And here debit and credit rules are: debit, if asset value increases or liability value decreases, we should debit. Similarly, if expenditure value increases or income value decreases, we should debit. If loss value increases or profit decreases, we have to credit. In conventional method, personal account, debit means what? Debit the receiver. Real account, debit means what? Debit what comes in. In nominal account, debit means debit all expenses and losses. So in conventional method, receiver, coming asset, expenses and losses are debited. Under American accounting method, debit means this. Similarly, come to credit. In conventional method, credit means what? In personal account, credit the giver. means giver is a credit. In real account, credit what goes out, means from the firm if any asset is going credit. In nominal account, credit all incomes and gains, means incomes and gains credit. But under American accounting method, credit means what? Increase in liability, decrease in asset. Increase in income, decrease in expenditure. Increase in profit, decrease in loss. So previous transaction, loan taken from SBI. Under American accounting method, how to record these transactions in the books, let us see. So think from firm's point of view. From State Bank of India, we are taking loan. So from bank, cash is coming. Here, cash is an asset, no? So in this transaction, asset value is increasing. When asset value increases, we should debit, no? So cash account, we should debit. And we have taken loan from State Bank of India, from an outsider. So a liability is increased. When liability increases, see this one, increase in liability we have to credit now. Therefore, final entry is cash account, asset account we should debit, loan from State Bank of India account, liability account we have to credit. So entry is cash account at R2, loan from State Bank of India account, 10,000, 10,000. So in conventional method also, by using golden accounting rules also, same entry came now. So answer is same, only analysis is different. And this transaction, how it affects balance sheet, let us see. Balance sheet is divided into two sides now, liability side, asset side. So liability side, what we record? Capital under liabilities. So owner's investment amount and loans taken from outsiders. These two on liability side we should record. Asset side, cash. So in this transaction, cash is increased. Therefore, cash asset 10,000 here. And a loan, that is loan from SBI is created. So loan from SBI 10,000 under liability side. See, our accounting equation is asset is equal capital plus liability. Capital plus liability means equity only, no? So asset is equal to equity. Capital and liability in balance sheet, left side we are writing. Means equity, left side we are writing. And assets, right side we are writing. So cash is debited. Means debits, asset side we are writing. Loan is credited. Means credits, liability side we are writing. And see the amounts, same. That only I said previously. Every transaction, two times we record. So one time in one account, debit side we record. Second time in another account, credit side we record. So amounts also same. Debit, credit amounts are same. That is why in balance sheet also, asset side debits, liability side credits, amounts are same. Therefore, accounting equation is asset is equal to capital plus liability. Now you will understand this accounting equation meaning sentence. Accounting equation is a mathematical expression. See, this is one formula only now. It is expressed in terms of maths. Mathematical expression which shows that the assets and equity. So assets, cash, equity, capital plus liability. In our example, only liability is there, capital is not there, capital is 0. So asset and equity of a firm are equal. Two side amounts are equal. So this is accounting equation. So accounting equation tells that every transaction we have to record two times. Because accounting equation is applicable to double entry system. In double entry system only, every transaction we record for two times now. So in one account debit side we record this transaction, in another account credit side we record this transaction. Debit means assets, credit means equity, nothing but capital plus liability. And debit side, credit side Under double entry system, we record same amounts. Therefore, when you prepare balance sheet, liability side, asset side, you should get the same totals. So, balance sheet is prepared based on accounting equation. Whatever transaction you take, it satisfies this accounting equation. So, we will take some transactions now and we will see in every transaction whether this accounting equation is applicable or not. Let us see in these transactions how this accounting equation comes true. First one is, sometimes in one transaction asset increases and capital also increases. For example, transaction is Ravi brought additional capital 1 lakh rupees. Ravi is the owner of one firm. Already he brought capital 15 lakh rupees. Now extra capital he is bringing. So what is the result of this? To explain all these transactions, I am taking this example. Asset is equal to 20 lakh rupees, capital 15 lakh and the liability 5 lakh. Because of this transaction, how these values change? Additional capital 1 lakh is coming now. So capital is a 15 lakh rupees. When owner brings extra capital, then capital increases no? Now capital becomes 16 lakh rupees. There is no change in outside liability. So outside liability is 5 lakh rupees is equal to 1 lakh rupee cash is coming into the firm. So cash is an asset no? Because of this transaction, asset total also increases by 1 lakh. Now asset total is 21 lakh rupees. So finally 16 lakh plus 5 lakh is equal to 21 lakh rupees. So after this transaction also accounting equation is same. Asset is equal to equity. Here equity means capital plus liability. Then second one is increase in one asset, increase in one liability. In some transactions one asset increases and one liability increases. Example, goods purchased for 10,000 from Prabhu. Here we purchased goods from one supplier known as Prabhu. So when supplier's name is given to us, meaning is we are buying goods from him on credit. So cash is not going. So what happened here? 10,000 worth of goods are coming into the firm. Goods is an asset now. So asset value increases by 10,000 rupees. Previously asset value 20 lakh. Now 10,000 worth of goods are coming into the firm. Therefore asset value becomes 20 lakh 10,000 rupees is equal to. There is no change in capital now. Capital amount remains same, 15 lakh rupees plus 5 lakh rupee. Our assumption is owner has taken bank loan 5 lakh. So here banker is outsider now. So from outsider we are taking loan. That is why this 5 lakh is coming under liability. And Prabhu supplier is also an outsider. So because of this transaction, a creditor is created with 10,000 rupees. Creditor means we have taken benefit from him and we have to pay to him. So we are owing to him. Creditor is a liability, outside liability. So liability value is increased by 10,000 rupees. Previously liability value 5 lakh plus 10,000, total becomes 5 lakh 10,000. Now 15 lakh plus 5 lakh 10,000 is equal 20 lakh 10,000. So here also accounting equation is true. Asset is equal to equity. Third one, in some transactions, one asset value decreases and the capital also decreases. Example, depreciation on machinery 5,000 rupees. Machinery is a fixed asset. When we use this fixed asset continuously, asset value decreases. That is called depreciation. So this is an expenditure to us. Depreciation is an expenditure. It is not a loss. Because loss means what? Without receiving any benefit, we lose some value. But here we are using machinery, By using this machine, we are manufacturing goods. In that process, machinery value is decreased by 5,000. So we are receiving some benefit and we are losing some value. Therefore, depreciation is an expenditure, not a loss. And because of this expenditure, capital amount will get affected. See, capital is owner's money. No? Suppose in business, owner earns some income. This income finally belongs to owner only. So, income will be added to capital. And in business, owner incurred some expenditure. Finally, who has to bear this expenditure? Owner only. So, with the expenditure, his capital amount decreases. No? So, if there is any income, it should be added to capital. If there is any expenditure, it should be subtracted from capital. Therefore, same equation, asset is equal to capital plus liability, we can write in another manner also. Asset is equal to capital plus income minus expenditure plus liability. So this equation is known as expanded accounting equation. So in this example, we use that expanded accounting equation because depreciation expenditure is given now. Depreciation on machinery. So machinery value is decreased by 5,000 rupees. Machinery is an asset. Asset value is decreased by 5,000. So 20 lakh minus 5,000. Final asset value becomes 19 lakh 95,000 is equal to. Depreciation is an expenditure now. Expenditure we have to subtract from capital. So capital is 15 lakh. Expenditure 5,000. 15 lakh minus 5,000 is equal to 14 lakh 95,000. Plus there is no change in outside liability now. Outsiders liability 5 lakh rupees. Finally 14 lakh 95,000 plus 5 lakh is equal to 19 lakh 95,000. So here also asset is equal to equity. Accounting equation became true. Next example. In some transactions, one asset value decreases and one liability value also decreases. Example, paid to creditors 20,000 rupees. Firm paid cash to creditors. So cash is going from the firm. 20,000. Cash is an asset now. Now asset value is decreased by 20,000. So after paying to them, remaining asset value is 19 lakh 80,000 is equal to 20,000 we paid to creditors. So this transaction doesn't affect capital now. Capital amount remains same, 15 lakh rupees plus liability decreases. Creditor value is reduced by 20,000. Creditor means outsider liability. 5 lakh minus 20,000 is equal to 4 lakh 80,000. Finally, 15 lakh plus 4 lakh 80,000 is equal to 19 lakh 80,000. So asset is equal to equity. Next transaction. Purchased machinery for 40,000. So in this transaction what happened? One asset value is increasing and another asset value is decreasing. Means this transaction is affecting only left side of accounting equation. Capital is not affected, liability is not affected. See, purchased machinery for 40,000. Seller's name is not given. Means this is cash purchase. So firm is buying machinery, in return firm is paying cash. Machinery is coming, cash is going. Machinery is an asset now. So asset value is increased by 40,000. 20 lakh 40,000. And we paid cash. Cash is also an asset. We paid 40,000 rupees cash. So another asset, cash is decreased by 40,000 rupees. So machinery value is increased by 40,000, cash value decreased by 40,000. Final result is in asset value there is no change. So 20 lakh 40,000 minus cash 40,000. Finally asset value becomes 20 lakh only. So asset value 20 lakh plus machinery minus cash is equal to capital, same, no difference, plus liability is also same. Finally, 20 lakh is equal to 20 lakh. Asset is equal to equity. Next example. In some transactions, one liability increases and another liability decreases. Example, bills payable accepted for creditors 4,000 rupees. So creditors means firm is due to them. We have to pay 4,000 rupees to some creditors. They need some written proof from us. So on us, they prepared bills of exchange and we are given acceptance to them. So what happened here? Creditor liability is converted into bills payable liability. So bills payable is a liability to the firm because in future on this bills of exchange, firm has to pay the money. So what happened here? One liability, creditor, is converted into another liability, bills payable. So there is no change in assets now. Asset value remains same, 20 lakh rupees is equal to, there is no change in capital also. Capital amount is 15 lakh rupees plus in 5 lakh rupees liability, creditor value is decreased by 4,000. So 5 lakh minus 4,000, 4 lakh 96,000. And the bills payable value, another liability value is increased by 4,000. So 4 lakh 96,000 plus 4,000, again 5 lakh rupees. So finally, liability value is 5 lakh. Capital plus liability is equal to assets. Next one, in some transactions, capital increases and decreases. Increase and decrease in capital in the same transaction. For example, interest on capital 2,000 rupees. Capital means what? This is firm. Owner's name, suppose Ravi. Ravi is invested 15 lakh rupees into the firm. This is known as capital now. As per business entity concept, owner is separate, firm is separate. So we should assume that from an outsider we are taking loan. When we take loan from others, we have to pay interest. No? So interest on capital, firm should pay to owner. Interest on capital is an expenditure to the firm because we have to pay. So what happened here? Capital 15 lakh, owner's money. Interest on capital 2,000. Firm has to pay to owner only. Means this is also owner's money. So now owner's money is 15 lakh rupee plus 2,000 rupees. Means capital is increased by 2,000 rupees. And interest on capital is an expenditure to the firm now. So expenditure we should subtract from capital. Capital 15 lakh minus 2,000. So to this 15 lakh, interest on capital 2,000 we are adding. Interest on capital, as this is an expenditure, we are deducting from capital. So 2,000 we are adding, again 2,000 we are deducting. Final result is there is no change in capital. So capital amounts remains fixed. 20 lakh rupee, there is no difference in assets now. Previously capital amount 15 lakh. It is increased by 2,000 rupees and it is decreased by 2,000 rupees. Finally capital amount is same. Plus there is no change in outside liability now, 5 lakh rupees. Finally equity is equal to asset. Next transaction, 8th one, increase in liability and decrease in capital. So in one transaction, liability increases, capital decreases. Asset value remains same. Example, retiring partner's capital account credit balance 50,000 is transferred to his loan account. So here capital and liability both are affected now. there is no change in assets. So asset value 20 lakh rupees is equal to retaining partners capital account credit balance 50,000. Assume that this is partnership business. Partners are A, B, C. Say C is retiring from the business. Then AB has to return his due amounts to him. So his capital, in revaluation account his share of profit, in goodwill his share, in general reserve his share. So all these amounts we show on credit side of his capital account. Finally, that amount is 50,000. So existing partners have to pay 50,000 rupees to retiring partner. If they have cash, ready money, then immediately they pay that. If they cannot pay immediately, they transfer this amount to retiring partner's loan account. So here, existing partners are transferring his due amount to loan account. 50,000. Previously, it is a credit balance of capital account now. Means in this 15 lakh rupees, 50,000 is also there. And now existing partners are transferring this capital into loan account. Then from 15 lakh rupees, 50,000 will be subtracted. So remaining capital amount is 14 lakh 50,000 plus. Now C retired. When he retires, to existing partner C becomes one outsider. So to this outsider, existing partners have to pay 50,000 rupees. So outsider's loan liability is increased by 50,000 now. Now liability value becomes 5,50,000 rupees. So capital decreased by 50,000, liability increased by 50,000. Finally, these two amounts total 20 lakh. So asset is equal to equity. Next, last one, increase in capital and decrease in liability. Example, debentures 2 lakh rupee is converted into shares. So here we are concentrating on company accounts. So company, for their capital requirements, they depend on different sources like equity shares, preference shares, retained earnings, debentures, bank loans, institutional loans, public deposits. Here, company has taken loan from the public. So as an acknowledgement, company issued debentures to them. So debenture comes under liability because debenture holders are outsiders of the company. Shareholders are company owners. So from shareholders, if company collects any amount, it comes under capital. From debenture holders, if company collects any amount, it comes under liability. Because debenture holders are outsiders, shareholders are owners. When owners invest money into the business, that is known as capital. No? So previously what happened? 2 lakh is included in this liability. Right? Now, one liability, debenture, is converted into share. So what happens to outside liability value? Decreases by 2 lakh. Previously 5 lakh, now it becomes 3 lakh rupees. And debentures are converted into shares. So share means capital only. Because of this, share value is increased by 2 lakh rupees. So 15 lakh plus 2 lakh total 17 lakh is the capital value now. 17 lakh plus 3 lakh is equal to 20 lakh. Finally, asset is equal to equity. Thus, whatever may be the transaction, it will be recorded on left side and right side. And the amounts will be the same. Because double entry system we follow to record all these transactions. So based on this double entry concept only, accounting equation is created. So how this accounting equation is useful to the firms? Suppose a firm is maintaining computerized accounting. So tally, focus, whatever transactions we are entering into the system, By following accounting equation, we have to enter. Otherwise, system is not going to take the transaction. So whether transactions are properly entered into the system or not, whether transactions are properly recorded in the books or not. So to confirm that, accounting equation acts as a cross check to us. So this is accounting equation concept. Hope this video is helpful to you. Thank you.